Millions of Americans are quietly parked inside whole life insurance policies, trusting that their money is safe. But what actually happens if the company holding your cash value starts to crack? This isn't a paranoid fantasy. It's a question that 1984, 2008, and Executive Life's spectacular collapse in 1991 all answered in ways nobody wanted to learn the hard way. Let's back up and understand what's actually happening inside one of these policies. Because whole life is not a savings account wearing a trench coat. It's a long-term contractual obligation backed by the general account of an insurance company. When that company invests your premiums in bonds, real estate, and other instruments, you're essentially an unsecured creditor with a very fancy agreement attached. Insurance companies don't just wake up one morning and evaporate. They deteriorate slowly, usually through bad investment decisions, underpriced liabilities, or a catastrophic mismatch between what they owe policyholders and what their assets can actually deliver. Think of it like a restaurant that keeps promising free dessert to every customer. Eventually, the kitchen runs out and the math becomes someone else's problem. Here's where the regulatory structure actually earns its keep. Because insurance companies are not regulated at the federal level like banks. They're supervised state by state, and each state has its own early warning system. Regulators monitor something called risk-based capital ratios. And when those numbers start dropping, examiners move in long before the doors close, which is fundamentally different from how a bank failure unfolds over a weekend. The first thing that likely happens when an insurer gets into serious trouble is rehabilitation, not liquidation. A court-supervised restructuring where the state takes control and tries to stabilize the company like a financial defibrillator. If rehabilitation fails, then liquidation begins. And that's when the safety net you've probably never heard of quietly catches you. State guarantee associations are the unsung backstop of the insurance world, and every state has one funded by assessments on all licensed insurers doing business there. These associations step in and either transfer your policy to a healthy insurer or continue paying claims directly, which means your death benefit and cash value don't simply disappear into the ether. Now here's where we have to be brutally honest about the limits. Because guarantee associations are not the FDIC with unlimited federal firepower. Coverage caps vary by state, and most states protect whole life cash values up to around $300,000 and death benefits up to $300,000, though some states set that ceiling as high as $500,000. If your policy exceeds those limits, the portion above the cap is genuinely at risk. And that's not a detail buried in fine print, it's the central vulnerability most agents never mention. The timeline question is where people understandably lose their composure, because guarantee association proceedings can stretch across years, not weeks. Executive Life's resolution dragged on for the better part of a decade, and policyholders in rehabilitation scenarios sometimes had their cash value access temporarily frozen during that period. The irony is that whole life is marketed as the slow, safe, boring alternative to the stock market. Yet in a failure scenario, you might find your liquid cash value about as accessible as a checked bag at a bankrupt airline. History does offer genuine reassurance here, because no policyholder in the United States has ever permanently lost a covered death benefit due to an insurer insolvency where guarantee association protections applied. That's not a marketing slogan, it's a verifiable track record across multiple high-profile failures, including Confederation Life in 1994 and Mutual Benefit Life in 1991. The common misconception worth destroying immediately is the idea that a mutual company, one owned by policyholders, is magically immune to failure because there are no shareholders to blame. Mutual Benefit Life was a mutual company with over $6 billion in assets when it was seized, which should permanently retire the notion that ownership structure alone equals safety. So what do you actually do with this information right now? First, verify your state's specific guarantee limits at the National Organization of Life and Health Insurance Guarantee Association's website, because the difference between your state's coverage and your policy's face value is your real exposure number. Second, if your policy's cash value or death benefit exceeds those limits, diversifying across multiple financially strong carriers, each rated A or better by AM Best, Moody's, or Standard & Poor's, is the rational, boring, effective solution. The disciplined move here is not panic surrendering your policy or chasing some other shiny financial product. It's understanding your actual exposure, checking your insurer's financial ratings annually, and sizing your coverage appropriately across institutions. Process and position size beat conviction every single time, and that's as true for insurance as it is for any other financial instrument. At a philosophical level, the entire structure of whole life insurance is a bet on institutional permanence across decades. And building redundancy into that bet is not pessimism, it's engineering. Comfort with uncertainty doesn't mean ignoring it. It means structuring your affairs so that even an unlikely bad outcome lands inside a boundary you consciously chose. The system, imperfect as it is, was specifically designed to make insurer failure a manageable inconvenience rather than a catastrophe for ordinary policyholders. And understanding exactly where your coverage stands within that system is the difference between informed ownership and expensive faith. You now know more about guarantee associations than most licensed insurance agents will ever voluntarily tell you. And if you're thinking about how whole life fits into a broader financial strategy involving real estate, leverage, or building long-term wealth, check out our links in the description below. We can help you get started, whether it's real estate investing, home contracting work, or finding the right lenders.